A trading insider reveals the truth about those online trading courses. Watch to the end for the biggest reveal ever. You've probably seen many people selling trading courses online. They promise to teach you how to trade, but often they just flaunt their fancy cars, big houses, and their intense stares at charts, as if they could change market directions with their gaze. But here's the thing, some of them could be fake gurus. First off, you should know this. I know I look like a stupid cat with a big belly, but surprisingly, I do a bit of trading, or more specifically, swing trading, which is to hold a position for days or weeks. My profits are low, and I won't want to disclose them, but here's the thing, I won't teach you what to do. In fact, I hope you lose money. Watch on and you'll know why. Now here's why those courses might not be useful after all. I'm going to simplify everything, so if any professional trader sees this, just know that I'm a cat, not a full-time day trader. If they know what day trader means, you see, firstly, you need to know two reasons why people buy stocks. One is called value investing and one is called trading. Value investing is simple. You put $1,000 into Apple stocks in year 2000, and today that $1,000 will become $213,000. So you really need to look deep into the company and whether it'll grow or flop. That isn't usually what trading gurus teach because this takes time for you to see the returns, although it's much safer. The other is called trading, in which you don't care about the company, but about how its stock prices go up and down within a day or weeks. You see, here's the thing. For value investing, whether the stock price goes up or down depends on the company, right? However, short-term fluctuations over days or weeks often don't reflect the company's actual status. So what caused the minor changes? Here's the shocker. It's often driven by everyday retail investors like Mary, Peter, and perhaps you. You see, there will always be many people who come in to buy Apple stocks after seeing that its stocks are increasing and hearing from their friends that they should buy now. These people are very predictable. They won't sell even when stock prices go down because they know it'll eventually go up. Then, at a certain point, they'll give up and sell, making a loss. Here's the thing. A trained trader earns based on Mary's and Peter's errors made by their emotions. It doesn't matter whether it's stock or Forex or heck, even the stock market in Neopets. The principle remains the same across all markets. Because the goal is to earn from Mary's and Peter's errors, so it works in any trade as it's all about human emotions, not the stocks or whatnot. You see, a trained trader used what is known as indicators to roughly project what Mary and Peter would do because these people would follow a pattern. For example, let's use the most popular one, the Morningstar pattern. So this is a pattern based on the candlestick chart. I know you don't know what it is, but that doesn't matter. Just know that based on this, there is a chance that Mary, Peter, and many others might be causing a reversal in the stock price, changing the stock price from a downtrend to an uptrend. So a trained trader predicts it will go up and buys at that time. Now here's the thing, that is known as an indicator, and there are many, many indicators. A trader needs to know them and apply them to predict the movement, but it's never ever 100% accurate. So there's one thing that's actually much more important. Risk management. It's when traders set a specific plan to buy and sell and whatnot, not based on emotions, but solely on the plan. Because if you notice, while the issue with Mary and Peter and might be the lack of skills in looking at indicators, which is called technical analysis, the real main issue actually is their emotions. If they know how to cut losses, they won't lose so much, or in the same idea, win so much. Now here's the thing, you can learn technical analysis from books or Udemy courses. In fact, they're better since some of them work for banks or funds, places where they're expected to generate returns. But the key thing to learn is always about risk management, or more specifically, managing your emotions. Here's the thing, signing up for a course from a guru flaunting a Lamborghini signals a loss already. It shows you're led by emotions. Ask any active traders, they'll tell you the most important lesson in trading is to know how to manage emotions. Now, this is why I would rather there be more Mary and Peter, because technically speaking, traders gain profits from their losses. Remember though, I'm just a blue cat on the internet. Do your own research and never believe anything a blue cat says on the internet. In the meantime, if you think you've learned something, consider subscribing and also watch this video to be slightly smarter.